Welcome everyone to the August edition of the Shaw & Partners monthly video update. Now we can't really talk about July without talking about sport. It was an absolute feast. We had the FIFA World Cup, the Tour de France, the Commonwealth Games, the start of Test match rugby. From a sporting point of view, it was a very bullish month. But as distracting as all that was, there was also plenty going on in financial markets, and there were some interesting developments. So let's look at how the month of July panned out for markets around the world. The global share market index, the MSCI All World, lost 0.3%, but is still up over 22% over the last 12 months. US markets were mixed. The traditional Dow Jones index, it eked out a small 0.4% gain. The S&P 500 was pretty much unchanged, but the Nasdaq 100 fell 6.6%. I would say, though, that all those indices have returned close to or over 20% in the last 12 months. European markets did generally enjoy positive returns, but the Japanese market, we measure that by the Nikkei index, fell 8.1%. And in our little corner of the world, the Australians not only took out the lion's share of the gold medals at the Com Games, they also enjoyed stronger market returns. The ASX 200 lifted 2.3%, while the NZX 50 managed a 0.6% gain. Interesting to note, though, that over the last 12 months, the New Zealand market has outperformed the Australian market. Now, we're going to come back and talk about interest rates in slightly more detail as we explore some of the broader underlying narratives for the month, but we'll start that by looking at the ubiquitous AI trade. I'm hesitant to say the AI trade has matured, but has certainly developed. I think we can say, on the evidence of what we have seen in the US second quarter earnings season, that investors are now a little bit more discerning, and the AI trade is not simply a tide lifting all boats indiscriminately. What we have seen is investors and markets rewarding earnings and having less tolerance for high levels of spending without clarity or evidence of current or future earnings, not to mention the destruction of free cash flow that's being seen in some cases. Now, look, I can illustrate this by looking at the market reaction to a couple of recent earnings announcements, and we're going to focus here on the hyperscalers, the big end of town. So Microsoft reported at the end of the month its results for the second quarter, and shareholders would have been heartened to see the quite staggering 20% plus share price rise in the first few days after the announcement. And look, investors were cheering what was seen to be a restrained approach to future capital expenditure. In other words, they didn't increase their CapEx expectations, but they also were cheering strong results from its Microsoft Azure product. And that's seen as evidence that it is benefiting from its AI-related spending. Now, I can contrast this to the market reaction to Tesla, where investors were worried about the mounting costs of AI. The company reported negative cash flow for the second quarter and is spending over $25 billion on capital expenditure this year. And year on year, that spend is up over 142%. And their share price got hit 20% after the release of the results. There was also, in the month, a substantial pullback in the semiconductor index that we've mentioned previously. It's called the SOX index, the Philadelphia Semiconductor Index, and it rose a ridiculous 100% between March and June. It's now given back roughly half of that surge. The big picture view, though, is that US earnings are still very strong, and that is supportive for the US share market. And the US economy actually continues to look pretty resilient. In the background, though, there is some macroeconomic uncertainty, and it's primarily in the form of the ongoing conflict in the Middle East. Now, last time we recorded this video, we were cheering the signing of the Memorandum of Understanding between the US and Iran. That optimism, though, proved to be fairly misplaced, with hostilities re-escalating in very short order. The oil price has been volatile, and I think we can expect that to continue until there is some sort of sustainable abatement of hostilities in the conflict. And there's still plenty of uncertainty as to when and how that will occur. Now, I just want to come back. I was going to talk about interest rates. There's a new chair of the Federal Reserve Board in place at the US Fed, and he's changing the playbook. His name's Kevin Walsh, and he's stated a preference for a lower level of forward guidance and commentary. Now, this is potentially unsettling for US interest rate markets, and we've seen longer term interest rates rising, with the important 30-year Treasury bond hitting levels that we haven't seen since the GFC, so that's over 20 years. This is a worrying development and one we will keep a close eye on over the coming months. Looking back home though, and we've got an election looming, haven't we? There does appear to be an underlying lift though in optimism. We can see it, it's evident through the business and consumer surveys released over July. And we can also see it in things like a material lift in building consents being issued, rising new car sales and the continued strong performance of our export sector. But it's a recovery though without the usual tailwind of higher house prices. So if this recovery does translate into higher levels of growth and productivity, this is a very welcome development. It does feel like, though, that we need a sustained period of stable and preferably lower oil prices for the optimism that we can see to translate into higher levels of activity. So we aren't making any significant changes to our current strategic asset allocation position, but at the margin, we're reducing our exposure to global bonds and we're feeling a little bit more positive on the local share market. Right now, there are plenty of cross-currents in financial markets, and it's our job to stay on top of those, to focus on the important stuff and to know what is relevant and will have a material bearing on investment portfolio performance. And that's the benefit of having professional help with your investment portfolio. That access to professional advice and experience, look, it just makes navigating the journey more dependable and it improves outcomes. And as well, we consider your long-term investment objectives and risk tolerances, so this gives you greater peace of mind about achieving your goals. So look, if you need help or you need guidance, why don't you get in touch with us? Then what we'll do is we'll bring our decades of experience to assist you in providing for your financial future. So give us a call. We'd love to hear from you. And if you want more information, you can look us up on shoreandpartners.co.nz or on Facebook or LinkedIn. We'd love to hear from you.